Hey, good morning, everybody, and welcome to this latest Trading Places Live at earningsbeats.com. I'm Tom Boley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to be with you. It is July 1st, 2025, so this is our first show in the second half of 2025, and what a crazy first half we had, right? I mean, we saw all-time highs, went into the year with some all-time highs, saw some fairly significant bearish rotation that led to our final all-time high on February the 19th. Then it was 2 days later, February 21st, we saw that massive rotation from consumer discretionary stocks to consumer staples. It was one of the worst days in terms of rotation from that aggressive consumer group to the more defensive group. I think it was the ninth biggest rotation day of the last 16 years. And that was one of those days that just kind of beat us over the head that, hey, we got some problems ahead. But we were able to get through it. We were able to navigate it, starting with the early April low. Saw a nice little rebound off of that. Got started with that massive day on the NASDAQ. I can't remember now if it was the biggest day ever on the NASDAQ or the second biggest day. I think it was the biggest day ever when we went up like 11 or 12%. It was back in that second week of April. And from there on, the markets just seems to have kind of, built on that strength, and to the point where we made it all the way back up, posted our all-time highs last week. And, we're in that territory now. And the good thing about it is we had our Q2, end of Q2 or Q3 outlook, depending on how you want to look at it. But we had our update last night for our members. And mostly blue skies ahead. When you get into all-time high territory, you look at certain things, make sure that the money is rotating in proper fashion, which it is. So I think we're starting off the third quarter in some pretty good shape. We've got earnings season getting ready to kick in here in a couple of weeks. Got a big jobs report coming up on Friday. And we'll see where we go from there. I think as far as the jobs go, I don't think anything necessarily would be viewed horribly. I think at this point, we've already got a negative GDP. So I think even if we got a shocking report and the jobs were negative, I think that would just simply put more pressure on the Fed to cut sooner rather than later. But I don't know that the market would take that too horribly, maybe initially, but I think we'd bounce back from it. I think the jobs are expected to come in somewhere around 100,000, and it will be on Thursday instead of Friday this week, since Friday's a holiday. So Thursday morning, get ready. That's when we're going to get that latest jobs report. But if we come in anywhere near that 100,000 level, maybe a little below, a little above, I think it'll just kind of be, that's what we're expecting, and that's what the market's been pricing in. So I don't think that would have a big impact. I think the only one that might have a big impact is if jobs just soared, because I think that would still keep open the possibility, folks still thinking about inflation. I think it also would keep the Fed on hold, potentially on hold, if you got a really solid jobs report and the unemployment report rate were to drop. I think something like that might stir the market a little bit more than just about anything else. But anyhow, we'll see how it plays out on Friday or Thursday, and how the market reacts to it. And then we'll have a long holiday weekend to try and absorb all the news and go into next week and get ready for earnings season, right? Anyhow, let me go ahead and set us up here. I don't think I did that just yet, but I'll get us set up so that we can switch over. Take a look at what happened last week, or actually what happened yesterday. And you can see from my chart here, I'll zero in for you. There we go. So you got the Dow Jones Industrial Average up almost 2/3% yesterday. So a pretty strong day on the Dow. S&P 500 up about 0.5%. NASDAQ up roughly about 0.5% as well. And if you go to the NASDAQ 100, which is a little bit more of those aggressive, large tech stocks, that actually rose about the same as the Dow, near 2/3%. So pretty good day in terms of many of those growth names. A lot of the Mag 7 stocks following suit to the upside as well. Small caps and mid caps were up early in the day, kind of following suit. Then they kind of tailed off in the last hour. A little disappointing from my perspective, because I am looking for the small caps to perform well as well. And they've been doing okay, but they've been lagging a little. And then, of course, right at the close yesterday, that was a little disappointing, not getting that the rally or at least hanging in with what the other indices were doing. But still, overall, all of our major indices right now are still in uptrends. They look solid to me. We've got a lot of sectors that are leading that strength, a lot of aggressive sectors leading that strength, and that always makes me feel pretty good about things. We got the VIX, which was up yesterday, even though the market was up. So that was interesting. We'll want to keep an eye on that. If that happens for a period of time, that can be a short-term issue in the market because it's telling you that fear is starting to build even while there's no reason for it to build. And so anytime the fear starts to build, the way I look at it is I kind of feel like the market isn't going to handle bad news very well. But again, that was one day that the VIX was up with the market. So if this becomes a pattern, we see this, say, over the next several days, then we might have a little bit of an issue. If the market keeps going up and the volatility index goes up with it, that would be a problem. And if we started seeing rotation into defensive areas while that was happening, that would just kind of compound the issue. But I'm looking ahead thinking, okay, these are some of the things we can watch for. That's not what I'm expecting. I'm expecting the market's going to keep going up. We're going to be supported by aggressive areas. And I think that VIX is going to drop and eventually be back down to 15, 14, 13, 12, probably down closer to the 10, 11 level as we get into the fourth quarter. But that's about it for the update on the major indices. We take our look at the sectors here, and this is what I was talking about. Yesterday, technology leading the move to the upside. So those high the higher market cap, the large cap tech names had really, for the most part, overall had a pretty strong day yesterday. Technology gaining almost 1%. Financials up 0.8%. And then you've got communication services also up almost 0.8%. Those are 3 of the 5 aggressive groups. So as the market moves up further into up into all-time high territory, we're being led by these aggressive areas of the market. This is what we want to see. Down at the bottom, though, we did see consumer discretionary. That was not a very particularly good day. But a lot of that was done. A lot of that damage was Tesla. And I saw Tesla, I believe, let me see, pre-market, I think Tesla was down pretty good today. Tesla was down $6 yesterday, which was about 1.8%. So that certainly weighed on discretionary because Tesla is one of the 2 largest stocks in the XLY. And if today's any indication, it's going to be a rough day for consumer discretionary because Tesla right now is down 5.5%, $17, back down to $300. It's been one of the more volatile stocks lately. Its sales have absolutely slowed across the entire globe, but especially over in Europe recently, talking about a big slowdown there. So Tesla, still a lot of bears jumping on that one and moving it back down to 300. Recent lows were down at around the 275, 280 level. So that's where I'd be watching on Tesla. As far as the overall market goes this morning, futures, right now I've got the diamond, which tracks the Dow Jones Industrial Average. That's relatively flat, down 0.05%. So not much there. The spider is down 0.2%. The QQQ is down 1/3%. And small cap IWM is down about 0.5%. So this is a little unusual because we've been waking up mostly to higher futures over the course of the last probably 2 or 3 weeks. But really, since the market's kind of gotten its feet under it and has started to move back to the upside, I would say really the last month or so, we've started to see a lot more gap ups and continuing moves to the upside. So this is a little different. We'll see what happens as we maybe consolidate some of the gains that we've had in recent sessions. But and of course, we don't know where we're going to finish. That's just where we're opening. So if we get movement back into some of those aggressive areas and we get more support, like we've been seeing in recent sessions, recent weeks, we could easily be right back up into green territory, possibly setting new all-time highs. But to start out, it does look like we're going to be a little bit weak this morning. Taking a look at where we stand on the major indices, you can see S&P 500 yesterday closing above 6,200 for the first time in history. So 6144 was that all-time high back in February that we cleared just a few days ago, and now we have made continuing advance to the upside. Now we clear 6,200 on Monday. NASDAQ 100 also continuing to move up, closing above 22.6 for the first time in its history. You can see this move to the upside. This is just straight up these last 6 days off that 20-day test. It has been just this huge move. And if there's one thing that maybe is a little bit disappointing to me, and I'll show you in just a second, is the IWM did the same thing, had a false breakdown on the 20-day moving average, reversed, but its gains have slowed here over the last couple of days. But before I show you that, I do want to show you that we do still have a negative divergence on the daily chart. But one of the risks you run when if you get in, you can see when we broke out above 22,000, we had a negative divergence. We've now run another 3% to the upside. We still have a negative divergence. But the point I want to make here is that if you jump in on these negative divergences too soon, if you look at a negative divergence, first time it prints, a lot of times it gets eliminated. It looks like negative divergences always work because you're looking in hindsight, and when you see the pullbacks, you realize that, oh, there was a negative divergence in play. Well, a lot of times there were negative divergences in play, but price action kept going higher to the point where the PPO turns up and eliminates the negative divergence. So you really never know until after the fact whether or not these are going to work or not. They're warning signs. They're telling you that the price momentum is slowing down. But if you're getting breakouts to all-time highs and it's being supported by relatively decent volume, to me, that combination of price volume trumps everything else in the market. Everything. If you're going up and you're breaking out to new highs and you've got quality volume backing you up, to me, there is nothing else in the market that trumps that. You might get some other warning signs that say, hey, you want to be careful if such and such happens. But there's nothing more important to me than breaking out and having nice volume. That combination is number one in my hierarchy as far as I'm concerned. And number two really isn't that close. So I'm always bullish when I'm getting breakouts to all-time highs, especially when it's being led by areas like technology. I don't really want to bet against that kind of a market ever. So NASDAQ 100 doing its thing, but we don't know how high this is going to go before we get a big potentially reversing candle. Maybe we go up another 10% first. Maybe this PPO rises and goes back above 3. And then all of a sudden you look at it and you say, wait, there's no negative divergence. It's because price action moves back up. When you're getting a breakout, you don't know where the momentum is going to end. It's hard to say you're losing momentum when you break to an all-time high. I mean, if you just think about that from a common sense perspective, we just moved to the highest level we've ever been in the history of the stock market, and you're going to try to convince yourself that the momentum is slowing. Probably not the best thing to do. Again, respect that breakout first, and then just understand that there is a negative divergence in play. That's a big difference than just going in all in and saying it's bearish. It's negative divergence. Let's get a reversing candle. Let's get something that suggests that the price action wants to turn back to the downside. And then I think that negative divergence would be more meaningful, at least to me. Small caps. So here's what I was talking about. See this false breakdown? It actually looked like it was taking out price support to the downside. I really loved that candle that day. When I saw it go back down and potentially break down below 207 and then come back up, not only to hold 207, but to finish at the high of the day at about a 5 or 6 day high, and also holding on to that rising 20-day moving average. A lot of times that's what catapults you back to the upside. Those types of candles, those types of false breakdowns and reversals. So, and that's what we saw. I was just showing you the NASDAQ, S&P 500. We've done that with the small caps, but you can see that the gains have just not been quite the same to the upside. So that's been disappointing, coming from somebody who has been trading a little bit more heavily in the small cap area, especially using leveraged ETFs, in this case, the TNA. Now, I'm fine with the IWM and the TNA as long as the IWM continues to trade above that 20-day moving average. But, nobody really wants to have gains erode, and be taken back, especially while other areas of the market are going up. So I'd like to see the IWM start to show some relative strength, and I'd like to see it today, or at least into the end of the week. One thing that could be a catalyst for small caps would be a not so good report on Friday or Thursday. I'm used to non-farm payrolls being on Friday as well, but they're coming out on Thursday. But if that report on Thursday shows lesser jobs than expected, or even potentially a negative jobs report to go on top of the negative GDP. Remember, GDP came in initially at minus 0.2%. Then they just bumped it to minus 0.5. So it was even weaker than they thought during Q1. Now we will get, in about 4 weeks, we'll get our first reading of Q2 GDP. We don't know where that's going to be at this point, but that'll be out in a few weeks. So not really anything to worry about at this point. But with a first quarter GDP that was negative, to then throw a negative jobs report out there, I'm telling you, if the Fed could look at that and still say we don't need a rate cut, I'd be shocked. So I think the market would interpret that kind of a report, a really weak jobs report, as, I don't know if it would be a surefire signal that the Fed's going to cut, but certainly it's going to put those rate cuts back on the table. And I think that kind of talk and that kind of reaction could benefit the small caps. So just something to think about later in the week. Transports. Transports made this breakout above about 15,200. I think that's very bullish. Kind of goes along with exactly what we're talking about in terms of the NASDAQ, S&P 500, even the small caps, breaking out of a bottoming type pattern, trending higher above the moving averages. I mean, we now have configuration on this transport chart. As bad as transports have been on a relative basis for the last few years, it couldn't look much better right now on its own absolute chart. We've got PPO in positive territory. That's telling us that we've got bullish momentum. That bullish momentum right now is accelerating. Last week or so, you can see that PPO picking back up again. So the momentum is accelerating to the upside. Price action is above a rising 20-day moving average, which is healthy and above the rising 50-day moving average. This right here is bullish, secular bull market setup. And I don't argue with this setup until the market makes me, until the market does something. Either, we lose the 20-day moving average, or we get a massive reversal with the negative divergence, which is possible. Big gap up. Maybe Friday's jobs report is ugly, or maybe it's whatever it is. It comes out, the market loves it. We get a big gap up and we trade up in the morning, and then in the afternoon we see nothing but selling all day long. And we get this bearish engulfing candle, and it's heavy volume. That could be a short-term kind of a problem for the market. Not 20% bear market type problem. I'm talking about maybe a 3 to 5% pullback kind of a problem. You get that kind of reversing candle with a negative divergence, you could see the selling last for a little bit. Now, do I expect that? No. We're heading into earnings season. I think the market's going to keep going higher. But again, I'm just kind of looking at different possibilities, assuming, hey, what if the report comes out bullish? What if it comes out bearish? Or I should say strong versus weak? What could that mean to the market? What could we maybe be thinking about and looking at? And what should we worry about? I don't really think there's a whole lot to worry about right now, but that would be one thing, is if we had a big gap up followed by a lot of afternoon selling. All right, technology. You can see technology, like the NASDAQ 100, S&P, and so forth. This breakout actually came earlier last week. So this was a little bit of a precursor, kind of setting the stage for the market to break out overall. Technology is about 31% of the S&P 500. It's probably more like 50% of the NASDAQ. And so when the technology group breaks out, it's a big deal. It's going to be hard, if you're on the bearish side and you're like, I need the S&P 500 to come down. Well, if you got 31% of it breaking to all-time highs, the other 69% better be having a lot of problems. Normally, the market's going to go in the direction of technology. I mean, if you think about, the stock market being like a body, the technology is like the head. And so if the head is going straight, it's going to be really hard to get the rest of the body to turn around and go the other way. And so that's the way I would be looking at this right now. I think we've got a technology group that's leading the market. outside of Tesla, which is definitely holding back discretionary right now. Discretionary, for the most part, has been performing well. Communication services, I see internet stocks. I'll pull that up for you right now. Let's take a look at the internet group. You can see internet breaking out above the recent high. We have not broken out above the February high yet, but we are definitely showing strength. You know, can we get all the way back up to that 5,600 and change? Yes, I think we can. I think we will heading into earnings. I think that we're going to continue to move up as we get closer and closer to some big earnings reports within this space. One being Netflix. Netflix has been absolutely on fire. We'll take a look at that chart. I mean, this has arguably been one of the best stocks over the last quarter. Early April, and this was when I was talking to a lot of our members. I mean, first of all, look at the AD line here, rising as prices were going down in March and April. You know, I do a separate Excel spreadsheet that I keep to track intraday action on individual stocks along with the major indices. And I look at it, I mean, it's proprietary, so I don't want to give too much information away, but basically I'm looking at it in a similar light to the way the AD line prints. And what I can tell you about Netflix is that back in March and April, I was seeing extremely bullish developments on the manipulation sheets that I'm following. Netflix, more than any other company, was seeing tremendous accumulation back in March when the market was going down. And you can kind of see that in the AD line. And then once we broke this downtrend line, we got into about the middle part of April right here. This thing absolutely took off. But we had talked about it with our members before it ever made this breakout and said, Netflix looks like the stock that is ready to explode. And look at what it's done. When this report comes out, they're going to have a very, very strong report. And it comes out, I don't know, probably 2 or 3 weeks, maybe 2.5 weeks. I think it's around the 17th, 18th of July. So normally that would be, you know, one of the first couple of companies to report. We'll get JP Morgan and some of the banks out, and then literally right almost on the heels is usually Netflix. So anyway, we'll be getting that report pretty soon. I expect a blowout report from Netflix. I think there's a major reason why we've been seeing all this accumulation, why this AD line just keeps soaring. And I think a lot of it has to do with word that's gotten out that, hey, their subscribership is probably growing through the roof. I imagine they're going to report strong earnings and revenues that are going to be above expectations. That's what I would expect based on what I saw all the way back in March, April, all the way through what we're seeing right now in Netflix. But this is a big component in the internet space. And so while internet hasn't broken out, you do have big components like Netflix that certainly have broken out. Another one that I think will be strong will be Meta. Meta, you can see, just broke to an all-time high, just took out the February high, although it did print a black candle. So maybe we pull back a little bit here in the near term, but I certainly don't expect it to go much below 700 to 710. If it were, you know, if it pulls back, that's where I would be looking for a reversal in the stock. And I expect, again, this is another one that was starting to move higher. We're up near 52-week high on the AD line. This is another internet stock that I think will have a good report. So again, do I think internet's going to break out? Yeah, I think internet's on the backs of some of these other large internet names. I think the whole group is going to be carried higher, and I think we're going to get a breakout. All right. So we've been having these events. So Saturday we had an event, and I talked a lot about the manipulation, and I wanted to make it an educational session. I talked for 2 hours and 40 minutes. You can go to YouTube. That video is out there now. You can watch it. But if you want to learn how the market rotates and how it sets up for these bear market declines, like the one we just saw, like the one we saw in 2022, you really should watch the video. I mean, I try to put out a lot of information out there, free information, folks, free. Most people probably, most analysts, most folks on Wall Street probably aren't aware of a lot of the information that I share, stuff I've learned over the years. And I can promise you, if they did know it, and they're not going to share it with you. I'm trying to help folks learn how to navigate the market. It's not easy. This is set up for Wall Street to win and for us to lose. And that's what most individual investors do. They lose. They can't quite figure out that recipe to making long-term money in stocks. It's either they're greedy and they're going after small companies, which ultimately most of them never make it. So you're losing way too much money in companies that have a lot of hype, but aren't able to sustain it over long periods of time. Or they don't have the patience to stay with stocks that go through downturns. Companies like Apple and Microsoft and Netflix, they've been great long-term companies. But when they start to underperform and you see these other, new companies coming out and they're so exciting and they're jumping and everybody says it's the best thing since sliced bread, you just don't stick with those other long-term winners as long as you need to. I mean, if I had to go back and change one thing in my investing, it would have been, obviously with hindsight, buy Apple, buy Microsoft and so forth. But these are companies that have just shown for 40 years that how strong a company they are. And yet I can tell you that I did not own them for most of the years during their growth, because as a former practicing CPA, I always had that side of me that said, the PE ratio is 100 or 150, it's too high. But what you find with these really great companies is they are priced high for a reason. Wall Street knows. Anyhow, you need to check out that video. Go to YouTube and just pull up our channel at earningsbeats.com. Subscribe to our channel while you're there so you don't miss these events when we have them. Like the videos, that'll help us as well. Like this one right here, like this video, and subscribe to the channel. That would be great. But anyway, check that video out, because again, it was 2 hours and 40 minutes. So probably the last 30 minutes were question and answer. So I probably did at least a solid 2 hours of pulling up charts and showing you exactly how the bear market unfolded, what to look for next time, how the manipulation that took place at the bottom, while we've got all these Wall Street firms, parading onto CNBC telling us how horrible things are. And, we're going to lower our S&P 500 target. Things are so bad out there. And I can show you and point to you on the charts where they're accumulating. They're telling us one thing and they're doing something else. Then after the market goes back up again, isn't it great? Mike Wilson comes out from Morgan Stanley and raises his target on the S&P magically back to where it was before. I'm telling you, there are games being played. I'll leave it at that. But you got to check this stuff out. You got to learn this stuff. I watch everything Wall Street does on the charts, where the money's going. They've got a lot of really brilliant people in their firms. Obviously, they know where to put their money and when to put their money, but I don't trust them as far as I can throw them. And you shouldn't either. And the one advantage we have, and I always kind of cling to this one, is that once we realize when the market is ready to top and when it's ready to bottom, do you know how quickly we can get in and out? I can do it in my accounts in about 15 seconds. Wall Street, it takes weeks, because they're trying to buy up millions of shares, or they're trying to unload millions of shares. They can't just push the market order. Let's just buy this at market. Let's sell this at market. You can't do that with those kinds of shares. The market's not liquid enough to absorb it. So they have to hire market makers. Market makers provide that service for them to unload their shares over time, trying to get them the best possible price. How do they get them the best possible price? Pardon my French, but by screwing us. That's how they do it. And we just saw it. We're right back now where we were 3 months ago. What happened in between? How many of you panicked out of your shares? Be honest. Because whatever you panicked out of, they now have in their coffers. And everything's back to all-time highs. So as far as they're concerned, they got out the top, got back in at the bottom. They're loving life. How are the rest of us doing? Well, if you're following earnings beats, you're doing okay. We've had a pretty good year. When you say go to cash 2 weeks before a top, or even say, hey, The top is now confirmed. That was 2 days after the top. That was on February 21st when I said we saw that big rotation from discretionary to staples. And I said, this confirms it. Now it's just a matter of how low we're going to the downside. I wrote an article that day about it. You can go back and take a look at that at stock charts in the article section. Anyhow, you got to learn from this stuff. That's my point. It does no good if we just talk about it and then we run and we do the same thing in two years from now. Then it's done nothing. It hasn't helped us at all. If you learn from it and you're better prepared next time, it'll save you a fortune. So make sure you check that out. Anyhow, like the video. Seriously, if you're not a member at Earnings Beats, we'd love for you to be a member. But if you can't financially support us by becoming a paid member, you can still support us by following our videos, learning. Hopefully down the road, you'll feel more comfortable. Maybe, finances are in a better position. Maybe you can join somewhere down the road. But in the meantime, you can help us with that like button and the subscribe button. Did I pull this up for? It's a good question. It's in the strong earnings chart list. I know. I was just going to pull up this strong earnings chart list. So we do chart lists for our members. I mean, we do so many different things in addition to all the guidance that we've provided. We also do these watch lists where we filter a lot of different stocks, put them into a chart list that features certain characteristics. So in this case, strong earnings, as the name implies, these are companies in the last quarter that beat Wall Street estimates as to both revenues and earnings per share. You have to beat both or you don't get on this list. That's the first step. Second step, you got to be $5 or more. We don't look at the small dollar stocks, but anybody, you can certainly look at it. That's just not one of our preferences. So we filter out anything under $5, and then we also filter out anything that's not liquid. So if a stock trades 5,000 shares a day, it's not getting on this list. I mean, we've got a lot of members that follow us. We're not going to put stocks out there that aren't liquid. So normally it's just to give you some idea, maybe 200,000 shares a day. Now there's some, there's some common sense in there too. If it's 200,000 shares a day on average and it's a $5 stock, that's different than if it's 200,000 shares a day average and it's a $500 stock. Obviously, a lot more money goes into the one that's $500 and trades 200,000 shares a day. So, I take that into account as well. So if I'm looking at a stock that's kind of borderline liquid and it's a $5 stock, I might toss it out. I might get another one that maybe averages 175,000, but it trades for $680 a share. And I'll include that one. So anyway, just to give you a little bit of maybe too much detail. But that's how I put this strong earnings chart list together. But I go through thousands of earnings reports every quarter just to put this chart list together. And I have help. Matt Townsend helps me going through and looking a lot at, which companies are going to be reporting and what happens afterwards and how much did they beat by, how much they gapped up, all of that stuff we track. So it gives us a really good list. And of course, yesterday, one of our best stocks, this is a stock that I've talked about in the past, Magnite. They're in the advertising software space. And I know they work, at least as of about 6 months or a year ago, they had a really good announcement came out with Netflix. So Netflix is flying. I don't know if that's why Magnite's flying or not, but I can just tell you, I know that there's a connection there in the stock up over $3 yesterday, 14%. But you look at some of these winners on our strong earnings chart list. How about we got strong future earnings chart list? So let's say there are companies out there that didn't beat top and bottom line. Maybe they missed their revenues. Maybe they missed their earnings, but the stock's still in a stealth uptrend. We don't really want to necessarily ignore those companies, but they're not going to be on the strong earnings chart list. Instead, we look at companies that continue to trade well technically that are not on our strong earnings chart list, and we put them into what we call the strong future earnings chart list. And the strong future earnings chart list, you can see here is that group and how they performed top to bottom. We got raised guidance. So any companies raising guidance that meet certain filters, they got to be a $5 stock. I do look for liquidity. Sometimes if a stock has raised its guidance and it's just in this straight down, it's almost like no one's even paying attention to the guidance. There must be something else going on. I'll eliminate it. I won't include it. but just about every other company I will put in here. And we annotate these charts, by the way, some of the chart lists. This one, strong earnings, both of these, every stock in here has annotated support levels that when I look at the chart, what I see in terms of support. But you can see a number of stocks there. Of course, this is today's action, by the way, because the market did just open 5 minutes ago. And I'll show you one more chart list here. This is the strong AD. I just updated this over the weekend. This is one that we update about once a month, but it looks for stocks that's simply showing strong AD lines. I think there were 390 companies or something on this list. And so you got a lot of different angles at earnings beats. And we have a bullish trifecta chart list, which says, hey, if you're on a number of these chart lists, then you're included in the bullish trifecta. You got to be on the strong earnings, you got to be on the raised guidance, and you got to be on the strong AD. If you're on all three of those chart lists, then you automatically are on the bullish trifecta chart list, which I think right now has about 60 companies on it, something like that. Pretty good list of companies that have all been on the strong earnings, raised guidance, and have strong AD, showing pretty solid accumulation. Those are 60 pretty good stocks to start with if you're looking to invest in the market. Anyhow, let's go ahead and take a look at what's going on in the market as we get going here. The Dow is flat, S&P down 0.25%, NASDAQ down 0.5%. Small caps look like maybe they're coming back a little bit. There's mid cap, small cap, maybe a little bit worse. We'll see how it goes. Look at Tesla right now, down $23, back down below that 300 level again. As I mentioned earlier, 275 to 280 is an area I'd watch on Tesla. That's where I would expect it to hold as support. If not, it's going to put a lot of pressure on discretionary stocks. Coin finally pulling back a little bit. AMD showing some weakness. Let's see what's up today. Got some gambling stocks. Gambling stocks have been coming up. Their relative strength has been picking up. Obviously, it's picking up even more today. Got Wynn Resorts, Las Vegas Sands, and MGM, all three at the top of the S&P 500. So pretty good start to the day there. All right, that is it for me today. VIX, by the way, is up a little bit. Market's down, though, so that kind of makes a little bit of sense. Anyhow, that's it. We got a big jobs report on Thursday. So make sure you check that out and see how the market reacts to that. Big weekend ahead. Second half of the year underway. This time, we're in all-time high territory, just like we were when we started the first half, except this time, I think the underlying technicals look a lot better for the second half of the year. Have a great day, everybody. Happy trading.